Welcome back to Hey Eric Series, Ask a Realtor. Today I got a question about the difference between a fixed loan and an adjustable rate loan. Probably heard of the adjustable rate mortgages or the ARMs that were prevalent back in 2008, 2007. They still exist, they're just not as big of or as popular of a product. When you think about getting your home loan, typically you think about, doing a down payment and you have a fixed rate that lasts for 30 years. That's the most common home loan that you see people get. And right now that rate is probably floating around 6%, 6.5%. And that's the one you hear on the news all the time, like mortgage rates are they peaked out pretty high, now they're coming back down. But that is the traditional, commonly known mortgage rate. And when you get that mortgage rate, you have a fixed payment for the next 30 years. You have the principal and the interest that stays the same for all 30 years of that term. The things that do change sometimes is the escrow account. So if your taxes go up or if your insurance goes up or down, that escrow account is going to change. And your mortgage company actually collects that escrow money from you every month, and they put it in a separate account, and then they pay those taxes and insurance throughout the year or at the end of the year. So that's the only thing that changes when you have a fixed interest rate. Now to talk about an adjustable rate mortgage. Adjustable rate mortgages, like the name suggests, they can adjust. So you may buy your house, do a down payment, and then you have a rate, say it's like market or it's market plus 1%, whatever it is, say it's 5%. And then as rates adjust, as the Fed funds rates adjust up or down, your mortgage rate actually might go up or down. And that in turn is going to change your monthly payment. It resets every once in a while. And obviously it doesn't happen monthly. It might happen every year, every 2 years, whatever the terms are in your loan documents. Be sure to talk to a professional loan officer about this, but your payment can increase. It can decrease. So it's one thing to think about when you're buying a home. Sometimes you can do interest only loans also, where maybe you're not paying down some of the principal. You're just paying interest on the principal. And that's a way to get into a property without as large of a payment. Not something you recommend, but it depends on your situation and what's going on in your life. If you have questions, you want to talk to a great loan officer, I know one, I can refer you. If you want to talk about the housing market, feel free to schedule a call with me at the link below.